In this video, we're going to look at something called write-off. Sometimes the company determines that a customer amount that's owed cannot be collected from the customer. So first the company will try to collect the amount. They'll follow up with statements, they'll try to contact the customer, but after a while they determine that this amount cannot be collected and that the company is not going to spend more time and money trying to collect balances from the customer. At this point, they do what we call a write-off. A write-off is when the company removes the bad debt amount from the company's accounts receivable balance. When the company is writing off, what the company does is decreases the accounts receivable and decreases the allowance for bad debts account by the amount of the write-off, so by the amount of the bad debt. You can write these down so you can refer to the entries, but most of it kind of makes sense logically. If the company is removing the accounts receivable balance, they're taking it away from the amount owed, therefore accounts receivable decreases, and then the amount that they think they won't be collecting is also decreased. So the allowance account has what the company thinks they won't be able to collect from the customers, that amount also decreases. Now, after the company's written it off, as time goes by, sometimes something else can happen. The customer may come back and pay some of the amount that's written off. So they may pay all of it, or they may pay back some of the amount that was already written off. So when a customer pays the company after their balance is written off, the company has to follow a two-step process to record that payment. First, the company reinstates the customer's account by reversing the original write-off. The reason the company reinstates the receivable is so that the customer's account has a track of what had happened. So the customer account will show that the customer did pay off that balance. But to do that, the company first has to reinstate the write-off and then record the payment. To reinstate the amount written off, you just do the opposite of what you did previously to write it off. You increase the accounts receivable balance and increase the allowance for bad debts. When we are writing off, we decrease our accounts receivable and decrease allowance for bad debts. Now we're just doing the opposite. Then, to record the collection or the payment by the customer, you're going to decrease accounts receivable and increase cash. Be sure to review these entries until you're comfortable and you understand what's happening with the transaction. Now let's go take a look at an example. We're going to be looking at Alan's tutoring service, but for year 2. In a previous video, we looked at Alan's tutoring service year 1 when we learned about how to record the bad debt expense using the percent of revenue method. We completed the year 1 in that example, and at the end of the year, we had a cash balance of $2,750, a net realizable value of accounts receivable of $925, retained earnings of $3,675, and then of course we had revenue and revenue expenses and net income. When we move on to year 2, everything in the balance sheet will get carried over to year 2, but the income statement accounts reset. We had talked about that earlier. So what we're going to do is we're going to transfer over the ending balances of year 1 to our new question, which is year 2. When we were working on the percent of revenue method, I said it would help to keep track of the accounts receivable and allowance for doubtful accounts separately. We're going to do the same thing in year 2. So accounts receivable and allowance for bad debt accounts has balances that carry forward. What I did was I carried those balances to the individual accounts receivable and the allowance account, as well as the beginning balances of your financial statements here. Note that the income statement accounts do not carry forward, they get reset every year, but the statement of cash flows will have the beginning balance of cash that's the same as your balance sheet. Now let's continue with the rest of the question. It says Alan's tutoring service had the following transactions during year 2. They've given us a list of transactions. Yes, I know the numbering's off, but we will number them in order. And then they want you to use a horizontal financial statements model to show how each event affects the balance sheet, income statement, and the statement of cash flows. Let's go through each transaction one by one. The first one says ATS wrote off $70 of an uncollectible accounts receivable. So remember, we just talked about a write-off. When a company writes off, what that means is they've tried to collect the $70 and now they're giving up. They're saying, let's just get rid of it from our accounts receivable balance. So when a company writes off an accounts receivable amount, they're going to decrease accounts receivable and decrease the allowance for doubtful accounts. Now, net realizable value of accounts receivable here, as you remember, is the combination of both those two. Net realizable value is equal to accounts receivable minus the allowance for doubtful accounts. I want you to take a note and look at the net realizable value before the write-off. Net realizable value before the write-off is $925. Now let's do the write-off. When we are writing it off, what we're doing is we are subtracting $70 from accounts receivable. So I'm going to say write-off and subtract $70. That decreases accounts receivable. And then I also decrease the allowance account. And again, I'm going to call this write-off. Decreased by $70. That should be a negative. So both dollar amounts are decreased. Let me do a total here so you can see what the total dollar amounts are of each account. The dollar balance of allowance for doubtful accounts is $5. The dollar amount of accounts receivable is $930. So your net realizable value here is going to be $930 minus 5, which is equal to $925. That is after the write-off. The net realizable value is going to be $925. But look here, the net realizable value of accounts receivable before the write-off was also $925. So what you need to know is that a write-off has no effect on net realizable value because net realizable value has two components, accounts receivable and allowance for doubtful accounts. Both of these decrease by the same amount, so the net effect is the same. This is usually an exam question, so keep that in mind, okay? So now let's see how that transaction affects the financial statements. So for one, we're going to decrease accounts receivable. When we decrease accounts receivable, net realizable value decreases, so I'm going to put a negative 70. And then we're also going to decrease the allowance for doubtful accounts. When the allowance for doubtful accounts is decreased, it's going to increase net realizable value by 70, which results in a net difference of 0. That's why the net realizable value does not change before or after the write-off. Again, let's look at those two numbers. When accounts receivable decreases, net realizable value decreases. When allowance for doubtful accounts decreases, net realizable value increases, resulting in a net change of 0. That's how the balance sheet is affected. Does this affect the income statement? No, it doesn't. It's not a revenue or an expense. Does this affect the statement of cash flows? No, it doesn't. There is no cash involved in this transaction. That's a write-off. That's how you'd record a write-off, and that's how it would affect the financial statements. Now let's look at transaction 2. It says ATS provided $10,000 of tutoring services on account during year 2. Now we're back on familiar territory, right? So what does this transaction do? It increases revenue. The company earned $10,000 of revenue, and then it increases accounts receivable. So let's go ahead and record the accounts receivable account here. So this is revenue or sales on account. And that is 10,000. It increases accounts receivable. That increase of 10,000 has the effect of increasing net realizable value, so I'm going to put that as a 10,000 here. What else does it do? Well, we just earned revenue, and we know that revenue is a component of retained earnings, and retained earnings would have increased by $10,000. That takes care of the balance sheet. Does this affect the income statement? Yes, it does. We have revenues that increased by 10,000, which caused net income to go up by 10,000. Does it affect the statement of cash flows? No, it doesn't. Cash was not affected, therefore no statement of cash flows. Transaction 3. Transaction 3 says ATS collected $8,430 cash from accounts receivable. So for transaction 3, what are the accounts affected by the transaction? Accounts receivable decreases and cash increases. Let's first record accounts receivable. Here's collections. Collections cause accounts receivable to go down by $8,430. If accounts receivable decreases, so does the net realizable value. So here we're going to say net realizable value decreases by $8,430. What else happens? We got cash. So our cash increases by $8,430. Does this affect the income statement? No, it doesn't. We didn't earn any new revenue. We're just collecting revenue that we earned earlier. So it doesn't affect the income statement. Does it affect the statement of cash flows? Yes, it does. We just collected $8,430 of cash, so our cash increases by that amount, and it is an operating activity because this was for revenue that we earned earlier. That's transaction 3. Transaction 4 says ATS recovered a $10 receivable that it has previously written off. So remember in transaction 1 we wrote off $70? Well, it looks like the customer came back and paid us $10. They didn't pay us all of the $70, that they paid us $10. And then the next transaction says ATS recorded the collection of the $10 reinstated receivable. So your textbook is going to do this as 2 transactions, just like we did. It's a 2-step. The first is to record the recovery by reinstating the receivable, and the second is to record the collection. So that's the transactions 4 and 5. So for 4, this is where the company is reversing the write-off. Reversing the write-off means we're going to add it back to accounts receivable. So here's the write-off. Actually, the write-off was 70. We subtracted 70. Now reversing write-off is adding back 10. I'm going to delete this total because I'm going to run out of space. And then when we reverse the write-off, that's only one part. What else happens? We're going to also reverse the write-off from the allowance. So the write-off, we subtracted 70. We're just going to reverse that and add back 10. We're only adding back 10 because the customer only paid off $10 of that 70 we wrote off. So for transaction 4, when we recover a previously written off amount, we're going to reverse the write-off and reinstate the customer's account by adding back the accounts receivable and adding back the allowance for doubtful accounts. Now, if you look at it, both these accounts affect the net realizable value. So let's look at that. If accounts receivable increases by 10, that causes net realizable value to go up. So I'm going to put that as a positive 10. If allowance for doubtful account also increases by 10, that causes net realizable value to go down by 10. That causes negative 10 here. So plus 10, minus 10, again, sorry, that I don't know what happened there. So we're going to say, again, plus 10, minus 10 gives you no effect on net realizable value. So when we reinstate the customer's account, which is the reversing of the write-off, just like the write-off, there is no effect on the net realizable value. Does it affect the income statement? No, it doesn't. We're just dealing with the net accounts receivable and allowance for doubtful accounts. Does it affect the statement of cash flows? No, it doesn't. There's no cash involved. So that's transaction 4. Now that we put that $10 back to accounts receivable, let's record the collection. That goes as transaction 5. When we collect the amount, we know that we're going to decrease accounts receivable. That's by decreasing $10 in the accounts receivable, and we're going to increase cash. So if accounts receivable decreases, that affects the net realizable value. It causes net realizable value to decrease by 10. And then our cash increases by 10. That keeps the accounting equation in balance and takes care of the balance sheet. Now let's look at the income statement. Does it affect the income statement? No, it doesn't. We didn't earn any revenue or incur any expenses. Does it affect the statement of cash flows? Yes, it does. We received $10 of cash, so our statement of cash flows goes up by 10. What type of activity? It's operating activity. Now let's look at the next item. I know it says 4, it's supposed to be 6. It says using the percent of revenue method, ATS recognized the uncollectible account expense for year 2. The company estimates that 2% of credit sales are uncollectible. Now what we're doing is we're recognizing the uncollectible account expense for year 2 using the percent of revenue method. I copied over the formulas and your entry again, so you have some practice. To record your bad debt expense using the percent of revenue method, your formula is bad debt expense is equal to current period sales revenue times bad debt percentage. Well, let's go ahead and get the numbers. Bad debt expense is equal to current period sales revenue. Well, in this period, we know our revenue was $10,000 and all of it was on account. So our current period sales revenue is $10,000. The bad debt percent they told you is 2%. So you multiply it by 2% or 0.02. And that gives you a bad debt expense of $200. Once you have the $200 to record it, we're going to increase the doubtful account expense and increase allowance for doubtful accounts. Let's first do the allowance for doubtful accounts. That goes here. So this is the expense. And we're going to increase that by 200 here. If we increase the allowance for doubtful accounts, that has the effect of decreasing the net realizable value. So for our adjustment here, we're going to decrease the net realizable value by $200. What else happens? Our expense increased, and expenses are affected, or expenses affect retained earnings. Expenses cause retained earnings to decrease, so we're going to decrease $200 under retained earnings as well. That is your adjustment for bad debts for year 2. Now let's look at the income statement. Does this affect the income statement? Yes, it does. Our expenses increased by $200, causing net income to decrease by $200. Does this affect the statement of cash flows? No, it doesn't. No cash, no statement of cash flows. That takes care of the last item. Now, at the end of year 2, it shows that your net realizable value of accounts receivable is $2,285. Our accounts receivable has a balance of, let me total it here, $2,500. Your allowance for doubtful accounts has a total of $215. $2,500 minus $215 is your net realizable value, which is $2,285. This company has accounts receivable of $2,500, but they think $215 of it could not be collected. Therefore, what they think they can collect is $2,285, which is the net realizable value. That's it for this video. I know this was a lot of information. Please rework this question. It is in your textbook, so you can go through your textbook and follow step by step as well. Please let me know if you have any questions.